Before we begin, it's important to understand that the content in this video is for educational and informational purposes only. It is not financial, investment, or trading advice. The foreign exchange market is subject to significant risk, including the potential for loss of principal. Past performance is not indicative of future results. Any decisions you make based on the information presented in this video are your sole responsibility. Always conduct your own thorough research and consider consulting with a qualified financial professional before making any investment decisions. This presentation is not an offer or solicitation to buy or sell any financial instruments. Imagine it's 3 a.m. The Tokyo market is buzzing, London is just waking up, and you're staring at a screen fueled by coffee and adrenaline. The US dollar is reacting to a surprise inflation report. The Swiss franc is twitching based on a central bank rumor you saw on an obscure news feed. And you're trying to calculate a dozen currency pair correlations in your head. Your finger hovers over the mouse. Is this a real breakout or a fake out? Is your analysis sound? Or is it just fear of missing out, a little bit of greed creeping in? Every trader on the planet knows this feeling. It's the lonely, high-stakes battle of human intuition versus a chaotic, unforgiving market. Now imagine a different scenario. As you sleep, a silent partner is working for you. It isn't human. It doesn't need coffee, it feels no fear, and it has no greed. It is simultaneously reading every inflation report, every central bank statement, every political tweet, and every news article from 1,000 global sources, in dozens of languages, all in real time. It's analyzing 20 years of historical price data, identifying microscopic patterns that no human eye could ever see. And it's doing this not for one currency pair, but for all of them all at once, executing trades with a speed and precision that is physically impossible for a person. This isn't science fiction. This is the reality of artificial intelligence in the world of Forex trading, and it's quietly creating one of the biggest revolutions in financial history. Over the next 10 parts of this series, we are going to pull back the curtain on this revolution. This isn't about hype or empty promises. This is about understanding. We're going to break down exactly what AI is in the context of trading, how it's being used by the biggest hedge funds and investment banks on Wall Street, and what its emergence means for the individual retail trader. Whether you've been trading for a decade or you've never even heard of a pip before, you'll walk away from this series with a clear understanding of the most powerful force shaping the future of the world's largest market. We're going to explore how AI is not just changing the rules of the game, it's changing the game itself. For decades, the Forex market was a contest of information and emotion. The trader who had the fastest access to news, the best gut feeling, the strongest nerve often had the edge. The legends of trading were built on stories of bold, intuitive calls. But the human mind, for all its brilliance, has critical limitations. We are susceptible to cognitive biases. We get tired. We get emotional. We can only process a finite amount of information at one time. When the market turns against us, we might revenge trade to win our money back. When we're on a winning streak, we might get overconfident and take on too much risk. We are, after all, only human. This human element has always been the great variable, the weak link in the chain of a trading strategy. For years, traders have tried to overcome this with rigid rules, automated scripts, and algorithmic trading. But these early algos were mostly just fancy calculators. They were rigid, following a strict if this then that logic. They could execute a pre-programmed strategy very fast, but they couldn't learn. They couldn't adapt. If the market conditions changed in a way the programmer hadn't predicted, the algorithm would just keep doing what it was told, often with disastrous results. It was like having a Formula One car that could only turn left. Fast and powerful in the right conditions, but useless the moment the track changed. Enter artificial intelligence. And when we say AI, we're not talking about Hollywood robots. We're talking about specific branches of computer science, primarily machine learning and deep learning. Think of it like this. A traditional trading algorithm is given a set of rules by a human. A machine learning system, on the other hand, is given a massive amount of data and a goal. For example, you could feed it 20 years of price data for the euro versus the US dollar, along with every corresponding news event, economic report, and interest rate change from that period. You don't give it rules. You just tell it, find the patterns in this data that historically precede a significant price increase. The AI will then sift through that mountain of information, running millions of simulations, testing countless hypotheses, finding subtle multi-layered correlations that a team of human analysts could spend a lifetime searching for and never find. It might discover that a specific combination of Japanese bond yields, German manufacturing output, and Brazilian commodity prices has an 80% correlation with a drop in the Australian dollar 3 days later. It's a connection no human would have ever thought to look for. And here's the most important part. It learns. As new data comes in every single second, the AI refines its own models. It adapts to changing market conditions. It evolves. It's not just a car that can only turn left. It's a self-driving car that is constantly learning to be a better driver on every type of road, in every kind of weather. So why is this happening right now? Why is this AI revolution exploding in this very moment? It's because of a perfect storm, a convergence of 3 technological tsunamis. First, big data. We are creating more data today than ever before in human history. Every financial transaction, every economic report, every social media post creates a new data point that an AI can analyze for market sentiment. Second, insane computing power. Thanks to advancements in graphics processing units or GPUs, which are perfect for the kind of math AI requires, we now have access to supercomputing power that was once the exclusive domain of governments and universities. This power is now available through the cloud, accessible to anyone with a credit card. And third, breakthroughs in algorithms. The underlying code, the very brains of these AI systems, has become exponentially more sophisticated in just the last few years. This convergence has created a new arms race. The major players are no longer competing for the fastest news terminals. They're competing for the brightest PhDs in machine learning. They're not building bigger trading floors, they're building bigger server farms. This isn't a gradual evolution. It's a paradigm shift. And it raises some profound questions. What happens when the majority of market participants aren't human? How do you compete against an opponent that can think a million times faster than you and feels no emotion? And most importantly, does this new technology shut the door on the individual trader? Or does it perhaps open a new one? These are the questions we will tackle head-on as we journey deep into the new world of AI-powered Forex trading. To understand how this new intelligence operates, let's forget about trading for a moment. Instead, imagine teaching a child to recognize a cat. You don't give the child a long list of rules like, if it has pointy ears for legs and a long tail, it's a cat. Why? Because a dog also fits that description. Instead, you show the child thousands of pictures. Pictures of black cats, white cats, tabby cats, cats sleeping, cats jumping, cats hiding in boxes. Over time, the child's brain, without any explicit rules, starts to build an incredibly complex, intuitive model of what cat is. It learns the subtle nuances, the shape of the eyes, the way the whiskers are positioned, the specific gait, that a simple checklist could never capture. This is, at its core, how machine learning works. And it's the engine driving the AI revolution in Forex. Instead of pictures of cats, these AI systems are fed an almost incomprehensible amount of data. Decades of historical price charts for every currency pair, down to the millisecond. They're shown every major economic data release, inflation reports, interest rate decisions, unemployment numbers, from dozens of countries. They analyze the text of central bank speeches, political news headlines, and even the sentiment of millions of social media posts. The AI's brain, a structure known as a neural network, processes all this information. Just like the neurons in our own brains, these artificial networks form connections, weighing different pieces of data against each other, constantly searching for patterns. It doesn't just look for the simple patterns a human trader might spot on a chart, like a head and shoulders or a flag formation. It looks for something far deeper. It might find a microscopic correlation between a slight increase in the price of Australian iron ore, a shift in the tone of a European central bank press conference, and a specific volume pattern in the Japanese yen that historically precedes a 40-pip move in the Aussie yen pair over the next 6 hours. This is a pattern no human could ever hope to discover. It's too complex, too subtle, buried under too much noise. For the AI, finding these patterns is its entire purpose. To really grasp its impact, we can break down the AI's role into 3 distinct, powerful functions. The first is exactly what we just described, pattern recognition on a superhuman scale. Think of a human trader as a detective standing at a single intersection, watching cars go by, trying to predict traffic flow for the entire city. They can make educated guesses based on what they see right in front of them, but their perspective is fundamentally limited. The AI, on the other hand, is like a satellite network with a live camera on every single car, at every intersection across the entire city, with a complete history of every traffic jam that has ever occurred. It doesn't just see the patterns. It sees the system that creates the patterns. It can analyze dozens of currency pairs across multiple time frames simultaneously, a cognitive feat that is simply impossible for the human mind. The second function is real-time data analysis, acting as an unblinking sentinel that never sleeps. The Forex market is a 24-hour-day, 5-day-a-week beast, constantly reacting to a fire hose of new information. A human trader has to sleep. They have to eat. They can't possibly read every news article, every report, and every tweet relevant to the global economy as it happens. The AI can. Using a technology called natural language processing, or NLP, these systems can read and, in a sense, understand human language in real time. When a central banker gives a speech, the AI isn't just waiting for a keyword like interest rate hike. It's analyzing the entire text, the tone, the specific adjectives used, the subtle deviations from previous speeches, to gauge market sentiment. Is the tone hawkish, suggesting tightening policy, or dovish, suggesting a more relaxed approach? It can scan thousands of news sources and social media platforms in seconds, measuring the collective fear or greed of the market. This sentiment data is then layered on top of the technical price patterns it has already identified, creating a rich, multidimensional view of the market that is far more complete than a simple price chart could ever be. This leads us to the third and perhaps most powerful function: predictive modeling and strategy optimization. With all this historical and real-time data, the AI can build sophisticated models that attempt to forecast the probability of future price movements. Now, this is not a crystal ball. It's not about certainty. It's about probability. The AI might conclude, based on the current market volatility, the recent inflation data from the UK, and the sentiment surrounding the US dollar, there is a 78% probability that the pound sterling to US dollar pair will move down in the next 90 minutes. But here's the critical step. The AI doesn't just trust its model, tests it rigorously. This is a process called backtesting. A human trader might spend a few weeks manually backtesting a new strategy on a year or two of historical data. The AI can simulate thousands of variations of a strategy across decades of data, through every imaginable market condition: bull markets, bear markets, periods of high volatility and low volatility, all in a matter of minutes. It can identify not just that a strategy worked in the past, but the precise conditions under which it is most likely to perform well in the future. It can adapt, refining its approach based on what the data tells it, discarding strategies that are no longer effective and discovering new ones that are. And this brings us back to one of our most important questions. What about emotion? The twin demons of trading for humans have always been fear and greed. Fear causes a trader to close a winning position too early, missing out on potential gains. Greed causes them to hold on to a losing position for too long, praying for it to turn around as their losses mount. After a big loss, a trader might engage in revenge trading, making reckless decisions to try and win their money back quickly. These are deeply ingrained human responses, and they are the primary reason why consistent profitability is so difficult to achieve. The AI has none of these flaws. It feels no fear when a trade goes slightly against it. It feels no greed when a trade is in profit. It doesn't get tired after watching the charts for 12 hours. It doesn't get angry after a loss and try to get back at the market. It operates with absolute, unwavering discipline. It executes its strategy based on cold, hard probability and data, 24 hours a day, without a single moment of emotional compromise. Every decision is calculated. Every action is based on the system it has rigorously tested and refined. This emotional detachment is perhaps the single greatest operational advantage an AI has over a human trader. It transforms trading from a psychological roller coaster into a disciplined exercise in statistical analysis. So, we now see that AI isn't just a faster version of a human. It's a fundamentally different kind of participant in the market. It sees patterns we can't, it processes information we can't, and it executes with a level of discipline that few humans can ever hope to maintain. The picture is becoming clearer. But this incredible power also raises a critical, and perhaps unsettling question. Is this technology solely the domain of billion-dollar hedge funds and elite Wall Street institutions? Are we witnessing the creation of an unbridgeable gap, where these technological giants dominate the markets, leaving the individual retail trader further behind than ever before? Or, in a fascinating twist, could this same technology be the very thing that levels the playing field for everyone? To answer that, we have to look at the very nature of the technology itself. It's a paradox. The same immense computational power that allows a hedge fund to build a fortress of algorithmic dominance is, in principle, the same power that can be scaled down and handed to an individual. Think of it like this. In the early days of flight, only governments and massive corporations could build and operate aircraft. It was an exclusive club. But over time, the principles of aerodynamics and engineering became understood, simplified, and eventually, a skilled individual could build and fly their own plane. We are at a similar inflection point with artificial intelligence in finance. The question is no longer if this power can be accessed by the individual, but how it's being done, and what it means for the person sitting at their home computer, looking at the charts. The great leveling begins with one single, overwhelmingly important resource: data. For decades, the retail trader was information poor. They had price charts, a handful of lagging technical indicators, and whatever news trickled down to them through mainstream media, often hours after it had already been priced into the market by the big players. Institutional firms, on the other hand, were information-rich. They had direct news feeds from Reuters and Bloomberg, teams of analysts poring over obscure economic reports, and the manpower to connect dots the average person didn't even know existed. They weren't just playing the same game on a different level, they were playing a completely different game altogether. AI fundamentally changes this dynamic. It is the ultimate data equalizer. An AI system doesn't care if it's running on a supercomputer in a Manhattan skyscraper or on a cloud server accessed by a laptop in Ohio. Its job is to process information at a scale and speed no human can match. Suddenly, the retail trader isn't limited to the evening news. An AI tool can be unleashed on the entirety of the internet. It can scan thousands of news articles, financial reports, government publications, and even social media feeds in the blink of an eye. It can analyze the sentiment of every article, track the frequency of keywords, and identify subtle shifts in narrative that might signal a change in market direction. This is the first revolutionary step: the transition from instinct-based trading to evidence-based trading. For years, the retail world has been dominated by gut feelings and simple pattern recognition. A trader might see a head and shoulders pattern forming on a chart and decide to sell, basing their decision on a visual cue that has been taught in trading books for 50 years. But what if that pattern is a trap? What if there's an underlying economic announcement from the Bank of Japan that completely invalidates that pattern, but the trader hasn't seen it yet? The AI sees it. The AI has already read the announcement, analyzed the language used, compared it to thousands of previous announcements, and calculated the probable impact on the yen. The human trader is acting on a picture. The AI-assisted trader is acting on a universe of context surrounding that picture. To truly grasp this, we need to demystify what we mean by AI in this context. It's not some sentient robot from a sci-fi movie. It's a set of specific, powerful tools. The first and most important is machine learning, or ML. Imagine you wanted to become an expert at identifying a specific type of bird. You could spend years in the field learning through trial and error. Or you could be given a library of 10 million photographs, all perfectly labeled with the correct bird species, and study them all in one afternoon. That's what machine learning does. It feeds the algorithm massive amounts of historical market data. Every price tick, every volume spike, every economic news release for the past 20 years. The machine learns from this data, identifying incredibly complex and subtle patterns that a human eye would never, ever be able to spot. It might discover, for example, that when a certain set of 3 economic indicators from both the US and the Eurozone align in a specific way, there has historically been an 80% probability of the euro to US dollar pair moving up by at least 40 pips within the next 6 hours. No guarantees, of course, just a statistical probability based on historical data. Then you have a component called natural language processing, or NLP. This is the AI's ability to understand human language. This is where it gets really fascinating. Central bank governors are masters of nuance. When the Federal Reserve Chair gives a speech, every single word is chosen with surgical precision. A single adjective can send markets soaring or tumbling. A human trader might listen to the speech and get a general feel. Was he optimistic? Was he cautious? An NLP algorithm dissects the speech instantly. It quantifies the tone, identifies key phrases, compares the sentence structure to previous speeches, and can deliver a hawkish or dovish score in milliseconds. It can do the same for 1,000 news articles about oil production or 1 million tweets about the Australian dollar. It transforms the messy, unstructured world of human communication into cold, hard, actionable data. When you combine these, the pattern recognition of machine learning and the language understanding of natural language processing, you get what's known as predictive analytics. Now, we must be extremely careful with this term. This is not a crystal ball. It does not predict the future. What it does is calculate probabilities. Based on all the available data, the historical price action, the current economic indicators, the real-time news sentiment, the AI can model thousands of potential future scenarios and assign a probability to each one. It might tell the trader, based on current inputs, there is a 75% probability of a price increase in the next candle, a 20% probability of a decrease, and a 5% probability of no significant change. The best way to think of this new breed of AI tool is not as an automated trading robot, but as the ultimate co-pilot. You, the trader, are still the pilot. You are in command of the aircraft. You make the final decision to take off, to land, to change course. But your co-pilot is an AI that has memorized every flight manual ever written, is monitoring 10,000 weather stations at once, sees every other aircraft in the sky, and is constantly running simulations of the safest and most efficient path to your destination. It might say, "Captain, I'm detecting some turbulence 100 miles ahead, and historical data suggests that climbing to 35,000 feet now would provide a smoother ride." You still have to fly the plane. You still have to execute the maneuver. But your decision is now infinitely more informed. Let's put it into a practical scenario. A retail trader, Sarah, is looking to trade the British pound against the US dollar. The old way, Sarah pulls up a chart. She sees the price is nearing a resistance level she drew last week. She reads a headline that says UK inflation is high. Based on this limited information and her gut feeling, she decides to sell, betting the price will bounce down from resistance. Now let's introduce an AI co-pilot. Sarah's AI tool has simultaneously analyzed the UK inflation report in its entirety, noting that while the headline number is high, the core inflation figures were actually weaker than expected, a nuance the headline missed. It has also scanned the latest statements from the Bank of England and detected a slightly more dovish tone than last month. At the same time, it's analyzing US bond yields and futures market data, which suggests underlying strength in the dollar. It cross-references the current chart pattern against millions of historical instances and finds that this specific setup, when combined with this particular mix of news sentiment and economic data, has resolved to the upside 68% of the time, breaking through the resistance level. The AI presents this to Sarah, a consolidated dashboard showing the conflicting data points, the overall sentiment score, and the historical probability. Sarah, the pilot, now sees the turbulence ahead. She can see that her initial gut feeling was based on incomplete information. She might still decide to sell, but her decision is now informed by a depth of knowledge that was, until very recently, the exclusive domain of a Wall Street trading floor. This is the power shift. It's the democratization of insight. The technology doesn't remove the risk, and it certainly doesn't remove the need for human judgment. But it does bridge the vast, cavernous information gap that has defined the markets for a century. It allows the individual to augment their own intelligence to see the bigger picture, and to make decisions based not just on what they see, but on what a machine can calculate from a world of data. The question this raises, however, is a critical one. This all sounds fantastic, like something out of the future. But is it real? Is this technology actually available and accessible to the average person right now? Or is it still just a toy for the ultra-wealthy and the tech elites? The short answer is yes. Absolutely, unequivocally, yes. But it's a yes with some very important footnotes. The technology is no longer confined to the glass towers of Wall Street or the server farms of Silicon Valley. What was once the exclusive domain of billion-dollar hedge funds using custom-built supercomputers is now being packaged, productized, and delivered to the screens of retail traders just like you. Think about it this way. In the 1980s, a machine with the processing power of your smartphone would have cost millions of dollars and taken up an entire room. Today, that power sits in your pocket. The same principle of technological democratization is happening right now with artificial intelligence in the world of finance. So, what does this actually look like in practice? When we say AI for retail Forex traders, what are we really talking about? It isn't one single thing. It's an entire ecosystem of tools, each serving a different purpose and requiring a different level of engagement. Let's break down the main categories you're likely to encounter. First, and perhaps the most common entry point for many, are AI-powered signal providers. These are services that use complex algorithms and machine learning models to scan the markets 24/7, looking for potential trading opportunities. They analyze a vast array of data points, far more than a human ever could, from technical indicators and price action to news sentiment and macroeconomic data. When the AI identifies a pattern that, based on historical analysis, has a high probability of leading to a certain market move, it generates a signal. This signal might be something like, potential buy opportunity for euro versus US dollar at this price, with a suggested stop loss here and a take profit target there. Imagine a trader we'll call Alex. Alex has a full-time job as a graphic designer. He's passionate about trading, but he can't be glued to his charts all day. He subscribes to a reputable AI signal service. Throughout his day, he gets alerts on his phone. He doesn't just blindly follow them. Instead, he uses them as a high-tech scanner. When a signal comes in, it acts as a tap on the shoulder saying, "Hey, you might want to look at this." Alex then opens his own charts, does his own analysis, and decides if the AI's suggestion aligns with his own trading strategy and risk tolerance. For Alex, the AI isn't a replacement for his brain. It's a powerful assistant, filtering the noise of the market and pointing him toward things that matter. These services lower the barrier to entry, but it's crucial to understand they are not a crystal ball. They are analytical tools that provide data-driven suggestions, not infallible commands. The second category is AI-enhanced charting platforms. Many of the platforms you might already be using, like TradingView or specialized broker platforms, are integrating AI features directly into their software. This is where AI becomes a true co-pilot for your analysis. Instead of you having to manually draw trend lines and search for classic chart patterns like head and shoulders or double tops, the AI can do it for you, automatically highlighting them on your screen in real time. But it goes deeper. Some of these platforms now have AI tools that can scan thousands of news articles, social media posts, and financial reports in seconds, and then display a sentiment score directly on your chart for a particular currency pair. So as you're looking at the price of the British pound, you can instantly see if the overall market sentiment, scraped from the internet, is bullish, bearish, or neutral. This is like having a team of 1,000 research assistants reading the news for you and giving you the summary. It's an incredible fusion of technical and fundamental analysis, powered by machine learning, right at your fingertips. Moving up the ladder in terms of sophistication, we have the third category, automated trading bots or expert advisors that are built with machine learning. Now, automated bots have been around for a while, but the old generation was fundamentally different. They were rigid, rule-based systems. You would program it to say, if the 50-day moving average crosses above the 200-day moving average, and the relative strength index is below 30, then buy. It would follow those rules perfectly. The problem is markets change. A strategy that worked beautifully in a trending market would get shredded to pieces in a sideways, choppy market. The bot couldn't tell the difference. It just kept following its rigid rules off a cliff. The new generation of AI-powered bots is different. They use machine learning. This means they can learn and adapt. Think of the difference between an old-school chess computer and a modern AI like AlphaZero. The old computer was programmed with a set of rules and opening moves created by humans. AlphaZero was just taught the rules of chess and then played against itself millions of times, learning, adapting, and creating strategies that human grandmasters had never even conceived of. The same principle applies here. An AI trading bot can be trained on years of historical market data. It can learn to recognize subtle shifts in market behavior, the market regimes we talked about earlier. It can potentially adjust its own strategy in real time, perhaps becoming more aggressive in high volatility environments or more conservative when the market is quiet, all without a human needing to recode it. This adaptive capability is the single biggest leap forward in automated trading. Finally, at the very top of the pyramid, is the fourth category, building your own custom AI models. This is the realm of traders who are also proficient in programming languages like Python, and have a solid understanding of data science and machine learning libraries like TensorFlow or PyTorch. These individuals don't use off-the-shelf solutions. They source their own data, clean it, engineer features, and then build and train their own predictive models from the ground up. They can design an AI to look for very specific, niche patterns that no commercial product would ever look for. This approach offers the ultimate level of power and customization, but it also requires a significant investment in time, education, and technical skill. It's not for everyone, but it shows the incredible depth and potential of what's possible when you combine trading acumen with data science expertise. So you have these four broad categories, from simple signal services to building your own AI from scratch. A helpful way to think about them is as a trade-off between accessibility and control. AI signal services are highly accessible but offer you the least control. You get the output, but you have no say in the process. AI-enhanced charting tools give you more control. They provide insights, but you are the ultimate decision maker. AI bots offer a high degree of automation, which can feel like less direct control over individual trades, but you control the overall strategy and risk parameters. And finally, custom-built models are the least accessible, but provide total granular control over every single aspect of the system. Now, this all sounds incredibly promising, and it is, but I have to pause here and share a word of caution, a story that brings this back down to earth. Let's talk about another trader. We'll call her Sarah. Sarah was new to Forex but was fascinated by the idea of AI. She saw an ad online for a revolutionary AI bot that boasted incredible monthly returns. Without much research, she bought it, installed it, and funded her account. For the first few weeks, it worked like magic. Her account grew, and she thought she had found the Holy Grail. But what Sarah didn't know was that this particular bot was not programmed with sophisticated risk management. It was designed to perform well in a calm, trending market. One afternoon, a surprise announcement from a central bank sent the markets into a frenzy. The bot, unable to adapt to this sudden, violent shift in volatility, kept opening trades based on its outdated understanding of the market. Within a couple of hours, Sarah's account was wiped out. Sarah's story is a critical lesson. AI is not a magic money machine. It is a tool. And like any powerful tool, whether it's a chainsaw or a scalpel, its effectiveness and safety depend entirely on the skill and knowledge of the person wielding it. An AI bot without proper risk management is just a faster way to lose money. A signal service followed blindly without your own analysis is just gambling with extra steps. The human element, the understanding of risk, the discipline, the strategy is not replaced by AI. It is amplified by it. The most successful traders aren't handing over the keys to a machine. They are learning how to use this incredible new technology to augment their own skills. So, we've established that the tools are real, they are accessible, and they come in many different forms. But this leads to the most important question of all. With so many options out there, with so many companies and developers claiming they have the next big thing, how do you separate the genuinely powerful data-driven tools from the dangerous scams and marketing gimmicks? How do you actually evaluate an AI trading tool and decide if it's right for you? This is the single most important question you can ask, because the answer doesn't just protect your capital. It defines your future as a trader in this new era. The line between a revolutionary tool and a catastrophic mistake is razor thin, and it's drawn with knowledge. So, let's build a framework, a mental checklist you can run any AI trading tool through before you ever let it near your live account. Think of this as your due diligence, your pre-flight inspection. First, we need to look under the hood. Not as a data scientist, but as a savvy investor. The first checkpoint is transparency of methodology. When a developer presents you with an AI tool, are they telling you what it does? Or are they hiding behind vague buzzwords like proprietary algorithm or secret neural network? A legitimate tool developer should be able to give you a clear, understandable overview of their AI's approach. For instance, do they specify if it's a trend-following model? Does it specialize in mean reversion? Is it designed for scalping during specific market sessions? Does it incorporate sentiment analysis from news feeds or just pure price action? You don't need the source code, but you do need a coherent explanation of its trading philosophy. If the entire sales pitch is, "It's a black box that just works," that is a colossal red flag. In trading, you are the pilot. You would never fly a plane without knowing how the controls work, and you should never risk your capital on an algorithm whose decision-making process is a complete mystery. Next, tied directly to this, is understanding the data diet. An AI is only as smart as the data it's trained on. Ask the question, what information is this AI using to make its decisions? A simple AI might only look at historical price data for a single currency pair. A more sophisticated one might be analyzing dozens of pairs, cross-referencing correlations, and factoring in volatility from options markets. A truly advanced system might be scraping financial news, central bank statements, and even social media sentiment in real time to build a multidimensional view of the market. The quality, depth, and breadth of the training data are direct indicators of the tool's potential sophistication. A tool trained on a decade of clean, high-quality data across multiple market conditions, bull markets, bear markets, and sideways consolidations, is fundamentally more robust than one trained on just the last year of a raging bull market. Once you have a conceptual understanding of the tool, it's time for the second, and arguably most critical phase of evaluation: performance verification. This is where most people get burned. They see a screenshot of a trading account with a 1000% gain and immediately get blinded by greed. We have to be smarter than that. The gold standard begins with backtesting. This is the process of running the AI strategy on historical market data to see how it would have performed in the past. Any credible developer will provide extensive backtesting reports. But here's the trap. It's called overfitting. Imagine you're training an AI to pass a history test. If you only train it on the exact questions and answers from last year's test, it might score 100%. It looks like a genius. But the moment you give it this year's test with slightly different questions, it fails miserably because it didn't learn history. It just memorized a specific dataset. Overfitting is the exact same concept in trading. An AI can be fine-tuned to look absolutely perfect on past data, dodging every crash and catching every rally. But this perfect strategy is often so specific to the past that it shatters the moment it encounters a new market dynamic it hasn't seen before. So how do you spot this? Look for consistency over a long period. A strategy that shows modest, steady gains over 10 years of varied market conditions is infinitely more valuable than one that shows explosive, unbelievable gains over a 6-month period. Also, look at the drawdown, the peak-to-trough decline in capital. A low drawdown suggests better risk management. But even the best backtest is just a simulation. The real test is forward testing, also known as paper trading or demo trading. This is where the AI runs in a live market with real-time data, but using simulated money. This is non-negotiable. You must see how the algorithm performs right now, in today's unpredictable market, before risking a single dollar. And I don't mean for a day or a week. You should let it run for at least a month, preferably longer, to see how it handles different events. A major news release, a surprise interest rate decision, or a sudden spike in volatility. Even better than your own forward test is a third-party verified track record. Services like MIFSpook or FXBlue link directly to a broker's trading account and independently track its performance. This is much harder to fake than a simple screenshot. When you evaluate these, ignore the headline monthly gain. Instead, look for longevity. Has the account been running for over a year? Look at the drawdown. Did it ever risk a huge portion of the account? Look at the profit factor, the ratio of gross profit to gross loss. A number above 1.5 is generally considered good, while anything over 2 is exceptional. A verified long-term track record is one of the strongest pieces of evidence you can find. Finally, we have the third pillar of our framework, risk management and integration. This is about how the tool fits into your trading plan. Does the AI allow you to set your own risk parameters? Can you define your maximum risk per trade, say 1% of your account balance? Can you adjust the stop loss and take profit levels? Or are they fixed? A tool that strips you of all control over risk management is not a tool. It's a gamble. You must always remain the chief risk officer of your own account. The AI can suggest a trade, it can even execute it, but you need to have the final say on how much you are willing to lose if that trade goes wrong. Consider its usability. Is it an expert advisor, or EA, that plugs into a common platform like MetaTrader 4 or 5? Is it a cloud-based service that sends you signals via email or an app? How easy is it to install and manage? Is there a dedicated support team you can contact if things go wrong? A complex tool with no support is a recipe for disaster, especially when real money is on the line. So let's summarize the red flags, the warning signs that should have you running for the hills. First, promises of unrealistic or guaranteed returns. The Forex market has no guarantees. Second, a total lack of transparency, the secret black box pitch. Third, no long-term verifiable track record. If all they have are backtests and screenshots, be extremely skeptical. Fourth, high-pressure sales tactics. A truly effective tool doesn't need a countdown timer to convince you. And fifth, systems that take away all control over risk management. Choosing an AI trading tool isn't like picking a piece of software. It's like hiring a crucial team member. It requires a rigorous interview process. You have to vet its philosophy, check its references, and test its performance in a controlled environment before you can trust it with real responsibility. This process might seem slow and tedious in a world that promises instant results, but it's the only way to harness the incredible power of this technology while protecting yourself from its potential dangers. So you've done the work. You've found a tool that checks all the boxes. It's transparent, it's been rigorously tested, and its performance is verified. The real challenge, the one that separates successful AI-assisted traders from the rest, is just beginning. How do you integrate this powerful new partner into your daily routine without letting it completely take over your own judgment? And what are the psychological traps that even the smartest traders fall into when they finally hand over a piece of their decision-making to a machine? The first and perhaps most crucial step is to reframe your relationship with the technology. Don't think of it as hiring an employee to do a job for you. Think of it as augmenting yourself. You are not handing over the controls, you are building a more advanced cockpit. Imagine a modern airline pilot. They don't fly a 787 Dreamliner by hand for 10 hours straight. They rely on incredibly sophisticated autopilot systems. But that pilot is never truly off. They are monitoring the systems, understanding the data, watching the weather, and are always ready to take manual control in a split second. They are the ultimate authority, the final decision maker. The AI in your trading should be your autopilot, not your replacement. So, how do you build this cockpit? It's a gradual process, built on verification and trust, much like training a new human partner. Let's call it the three-phase integration framework. Phase 1 is the analyst. In this initial stage, the AI's role is strictly limited to research and data processing. You are still the only one placing trades. The AI is your tireless, infinitely patient research assistant. It can scan every single currency pair, 24 hours a day, looking for the specific technical setups you've trained it to find. It can perform real-time sentiment analysis, scraping millions of news articles, social media posts, and financial reports to give you a quantifiable measure of market fear or greed, something a human could never do. It can flag complex correlations you might miss, like how a sudden spike in the price of oil might historically impact the Canadian dollar versus the Japanese yen. In this phase, the AI brings you opportunities and insights, but every single trade decision, every click of the mouse is yours and yours alone. You are the gatekeeper of capital. This phase is all about learning to trust the AI's data-gathering abilities while still flexing your own decision-making muscles. Once you've validated the AI's analytical skills, you can move to phase 2, the co-pilot. This is where you let the machine touch the controls but with a massive safety net. You open a demo account or a paper trading account. You give the AI the ability to execute trades based on its analysis, but with zero real money on the line. This is the most critical testing period. You're not just testing the strategy, you're testing the system itself. Does it execute at the right price? Does it set the stop loss and take profit orders correctly? How does it behave during a high volatility news event? Does a bug in the code cause it to open 100 trades at once? This is the flight simulator. You let the AI fly in all conditions, calm skies, turbulence, engine failures, all in a simulated environment where mistakes cost you nothing but a little bit of data. You might run this phase for weeks or even months, until you have a statistically significant set of results and a deep confidence in the system's mechanics. Only after a successful and lengthy co-pilot phase should you even consider phase 3, the specialist. Here you allocate a small, strictly defined portion of your trading capital for the AI to manage. And you don't just let it run wild. You give it a specialized task. For example, you might notice from your paper trading data that the AI is exceptionally good at scalping the euro to US dollar pair during the London session, but terrible at trading trends in the Australian dollar to Japanese yen. So, you deploy it as a specialist. Its only job is to execute that one specific strategy, on that one pair, during that specific time window. You, the human trader, are the portfolio manager. You manage the overall risk, you decide how much capital the specialist AI gets to use, and you have the kill switch. You can turn it off at any moment. The AI is a tool executing a task it has proven to be good at, while you focus on the bigger picture, researching new strategies, and managing the overall health of your entire trading operation. This phased approach ensures you are always in control. You build trust incrementally, based on evidence and performance, not on a blind leap of faith. But mastering this technical integration is only half the battle. The other, arguably harder half, is fought in the 6 inches between your ears. Because AI doesn't just introduce new technical tools, it introduces new and powerful psychological traps. The first and most dangerous is automation bias. This is our innate human tendency to overtrust suggestions from an automated system, even when our own intuition or evidence screams otherwise. Let's imagine a trader named Sarah. Her AI system has just closed out 8 winning trades in a row. It's been flawless. On the 9th trade, it signals a buy on a currency pair that is in a clear, screaming downtrend. Every ounce of Sarah's experience tells her this is a bad idea, that she'd be trying to catch a falling knife. But the thought creeps in. The machine has been right 8 times. It must be seeing something I'm not. So she overrides her own better judgment and takes the trade. The position immediately goes against her, and she takes a significant loss. That is automation bias in action. The antidote? Radical transparency. Never treat your AI like a mystical black box. You must understand the why behind its decisions. If your system uses a combination of moving averages and RSI, you need to be able to look at the chart and see for yourself that, yes, the moving averages have crossed and the RSI is below 30. If you can't explain the AI's reasoning in simple terms, you are no longer trading. You are blindly following an oracle. The second trap is what I call the siren song of the perfect backtest. With the power of modern computing, a trader can take years of historical data and tweak an AI's parameters endlessly until they produce a flawless result. They adjust the stop loss by a few pips here, change a moving average from 14 periods to 12 there, and after hundreds of iterations they have a backtest that shows a perfect 45-degree equity curve sloping up and to the right. It's beautiful, it's perfect, and it's almost always worthless. This is a phenomenon known as curve fitting, or over-optimization. You've created a system that was perfectly tailored to the unique market conditions of the past, but is incredibly fragile and completely unprepared for the reality of the future. The market is a living, breathing thing, it evolves. A strategy that worked perfectly from 2018 to 2020 might fail spectacularly in the face of new global events, new regulations, or new market dynamics. The psychological trap is falling in love with that perfect backtest and believing you've solved the market. The solution is to seek robustness, not perfection. A robust system is one that performs reasonably well across a wide variety of market conditions, even if it's not perfect in any single one. It's better to have a system that makes a little money in most environments than a perfect system that only works on a historical dataset. Finally, there's the trap of emotional transference. We're told AI removes emotion from trading, and in some ways it does. But often, it just changes the nature of the emotion. Instead of feeling fear when a trade goes against you, you feel a white-hot anger at the machine. Stupid algorithm. I knew I shouldn't have turned it on today. You start personifying the code, treating it like a disobedient employee. This can lead to revenge tweaking, where you jump into the code and impulsively change parameters out of spite, a surefire way to destroy a well-tested system. On the other side of the coin is complacency. When the AI is running smoothly and making money, it's easy to become bored and detached. You stop doing your own market analysis. You stop reading, you stop learning, you stop growing as a trader. You become a system monitor, not a market participant. And the market has a way of ruthlessly punishing complacency. The moment you think you don't need to learn anymore is the moment you become vulnerable. The key is to see the AI as a powerful instrument, like a finely crafted scalpel in the hands of a surgeon. The scalpel itself has no emotion, but the surgeon's focus, discipline, and continuous learning are what determine the outcome of the operation. The AI is a tool for execution and analysis, but you must remain the strategist, the student, and ultimately the one responsible for your own continuous growth. So let's pull back the curtain and look at the actual engines driving this revolution. When we say AI in trading, it's not some single magical black box. It's an entire arsenal of different computational models, each with a unique strength, a specific purpose. Understanding these different types of AI is like a grandmaster understanding the role of each piece on the chessboard. You need to know your pawns from your queen. First, you have the workhorses, the predictive models based on classical machine learning. Think of these as the ultimate chartists, the most diligent students of history you've ever seen. These algorithms, with names like linear regression, support vector machines, and random forests, are designed to do one thing exceptionally well: find patterns in massive amounts of historical data. They sift through years, even decades, of price action, volume, volatility, and dozens of other quantitative inputs. They look for subtle correlations that the human eye would almost certainly miss. Imagine trying to manually track the relationship between the euro to US dollar exchange rate, the price of German government bonds, and the volatility index every second of every day for the last 10 years. It's an impossible task for a human, but for a machine learning model, it's just another Tuesday. It ingests this ocean of data and builds a complex mathematical model of how these variables have interacted in the past. The goal is to then use this model to look at the current market conditions and calculate the probability of a potential future outcome. It's not a crystal ball. It's a hyper-advanced weather forecast for the market. It doesn't say it will rain. It says, based on analyzing 10,000 identical atmospheric pressure systems from the past, there is a high probability of precipitation. This is the foundation of many AI trading systems. using historical precedent on a scale we could never comprehend to inform future possibilities. But markets aren't just numbers on a chart. They are driven by something far more chaotic and unpredictable: human emotion. Fear, greed, optimism, panic. And this is where the second type of AI comes in, a category that's completely changing the game: natural language processing, or NLP. NLP is the science of teaching computers how to read, understand, and interpret human language. In the world of Forex, this is a superpower. The Forex market is uniquely sensitive to geopolitical events, central bank announcements, and economic news. A single unexpected phrase in a press conference from the Federal Reserve chair can send currency pairs into a tailspin. A surprise election result can cause volatility to explode. Historically, traders would have to be glued to news feeds trying to read and react faster than everyone else. Today, NLP algorithms do it for them, but at the speed of light. These AI models can scan thousands of news articles, tweets, official reports, and social media posts every single second. But they don't just read the words, they understand the sentiment behind them. They can differentiate between a hawkish and a dovish statement from a central banker. They can measure the collective sentiment of Twitter towards the Japanese yen, categorizing it as bullish, bearish, or neutral in real time. Think about the implications. An NLP model could detect a subtle shift in the language used in a European Central Bank report, a change that suggests a future policy shift, minutes before most human analysts have even finished reading the first paragraph. It can aggregate the sentiment from hundreds of financial news outlets to create a quantifiable risk-on or risk-off score for the entire market. This isn't just about reading the news faster. It's about understanding the collective psychological state of the market itself, turning the unstructured, messy world of human language into cold, hard, actionable data. This is how AI gives traders a potential edge in a news-driven market, by interpreting the global conversation before it's fully reflected in the price. Now, if predictive models are the historians and NLP models are the interpreters, then the third category is the grandmaster, the strategist, the evolutionary leap forward, reinforcement learning. This is where things get truly mind-bending. Unlike the other models that learn from a fixed set of historical data, reinforcement learning models learn by doing. They learn through trial and error just like a human, but on a massively accelerated timescale. Here's how it works in principle. You create an AI agent and place it inside a simulated market environment. You give it a set of actions it can take: buy, sell, hold, and you give it one simple objective: maximize its profit or another performance metric over time. Then you let it loose. At first, its actions are completely random. It makes terrible trades and loses a lot of simulated money. But here's the key. For every action it takes, it receives feedback in the form of a reward or a punishment. A profitable trade gets a positive reward. A losing trade gets a negative one. The AI's core directive is to figure out what sequence of actions leads to the biggest cumulative reward. And it learns by running through millions, even billions of simulations. It experiences countless market crashes, flash spikes, and sideways grinds in this virtual world. Over time, through this relentless process of trial, error, and feedback, it starts to develop its own strategies. It doesn't just learn to recognize a pattern. It learns a sophisticated policy for how to behave in different market conditions. It might learn that in a highly volatile market, it's better to take small, quick profits. Or it might discover a complex hedging strategy that no human has ever thought of. This is the same technology that powered Google's AlphaGo to defeat the world's best Go player. AlphaGo wasn't programmed with specific Go strategies. It learned them by playing against itself millions of times. In the same way, a reinforcement learning trading agent isn't just executing a pre-programmed strategy. It is, in a very real sense, creating the strategy itself. It adapts, it evolves, and it learns from its own mistakes on a superhuman scale. This is the cutting edge, the closest we've come to creating a truly autonomous and adaptive trading intelligence. So you have these three pillars: predictive models finding patterns in historical data, NLP models interpreting human sentiment, and reinforcement learning models forging new strategies through simulated experience. A sophisticated trading operation doesn't just use one, it orchestrates all three. It might use an NLP model to gauge market sentiment and determine the overall market regime. Based on that, it might activate a specific predictive model that performs well in that type of environment. And a reinforcement learning agent might be running constantly in the background, testing and refining the overall strategic approach. This is the new reality. The lone trader staring at a candlestick chart is now competing against a symphony of algorithms, each a specialist in its own domain. But this doesn't mean the human is obsolete. Far from it, because with this immense power comes immense complexity. Knowing which model to trust, how to configure its parameters, and when to intervene requires a deeper level of understanding than ever before. The strategist's role has never been more critical. You are no longer just a trader. You are the manager of a team of highly intelligent, incredibly fast, but ultimately specialized digital assistants. And how you manage that team is what separates success from failure. So, what does it mean to be a manager of these digital assistants? It's a fundamental shift in mindset. A great manager doesn't just hire a brilliant employee and then walk away, assuming everything will be perfect forever. They set the strategy. They define the key performance indicators. They monitor progress, provide resources, and most importantly, they know when to step in and course correct. The same principles apply directly to managing AI in the Forex market. The single biggest mistake a trader can make when adopting AI is falling for the set it and forget it fantasy. The allure is powerful. The idea that you can turn on a sophisticated algorithm, go live your life, and come back to a steadily growing account is the stuff of marketing dreams. But in the real world, the financial markets are not a static, predictable laboratory. They are a chaotic, living ecosystem, constantly influenced by human emotion, geopolitical shocks, and unforeseen events. An AI, no matter how advanced, is fundamentally a product of its training. It learns from the past. It identifies patterns and probabilities based on historical data. And it is exceptionally good at this, far better than any human. But what happens when something unprecedented occurs? A true black swan, event that has no parallel in the data it was trained on? Think about it like an advanced self-driving car. It can navigate highways, traffic, and complex intersections with superhuman precision because it has analyzed millions of miles of driving data. But what if a flock of flamingos suddenly landed in the middle of the interstate? The car's system, having never encountered this specific scenario, might hesitate or make a suboptimal decision. It needs the human driver to recognize the absurdity of the situation and take the wheel. In Forex, these flamingos appear all the time. A sudden shocking central bank policy shift. A flash crash triggered by a technical glitch or a fat finger error. A geopolitical event that sends shockwaves through the global economy. In these moments, an AI operating purely on historical patterns might interpret the massive volatility as a high-probability trading opportunity, failing to grasp the underlying qualitative reason for the chaos. It might double down when it should be pulling back, or exit a position just before a massive rebound, all because the current situation doesn't fit neatly into the models of the past. This is where the human manager becomes the most valuable asset in the entire system. Your role is not to be faster than the AI, you never will be. Your role is to be wiser. It's to provide the one thing that machine learning, in its current form, lacks: contextual understanding. You read the news. You understand the nuance of a politician's speech. You can feel the shift in market sentiment. Your job is to be the ultimate risk manager, the final line of defense against the unknown. This concept is often referred to as a human-in-the-loop system. It's a model where a machine and a human work in a symbiotic partnership, each leveraging their unique strengths. The AI handles the heavy lifting, scanning terabytes of data, identifying micropatterns across dozens of currency pairs, executing trades in milliseconds, and managing complex positions without a shred of fear or greed. It is the perfect tactical soldier, but you are the general. You see the whole battlefield. You set the rules of engagement. What does this look like in practice? It means you're not just turning the AI on or off. You are actively configuring its operational parameters. You might tell your AI, operate within these risk limits. Do not allocate more than 2% of the portfolio to any single trade. During periods where the VIX index is above a certain level, I want you to reduce your position sizes by half. You are building the guardrails. You are defining the sandbox in which your powerful tool is allowed to play. Furthermore, a human-in-the-loop approach involves periodic strategy validation. You don't just assume the AI's strategy is evergreen. You regularly backtest its performance against new market data. You analyze its wins and, more importantly, its losses. Was there a common theme in the trades that didn't work out? Did the market regime shift in a way that makes the AI's core logic less effective? A strategy that was incredibly effective in a low volatility, trending market might perform poorly in a choppy, sideways market. The human manager's job is to recognize that regime change and either recalibrate the AI, switch to a different algorithm better suited for the new conditions, or simply take it offline until the environment is more favorable. Let's walk through a hypothetical scenario. Imagine you have an AI that specializes in a carry trade strategy, borrowing a low interest rate currency like the Japanese yen to buy a higher interest rate currency like the Australian dollar. For months, it works beautifully, collecting the interest rate differential. The AI sees a stable, profitable pattern. But you, the human manager, start to see worrying economic data coming out of Australia. You hear whispers that their central bank might be forced to cut rates unexpectedly due to slowing growth. The AI doesn't read analyst reports or watch central banker press conferences. It only sees the numbers. It sees the interest rate differential is still positive, so it continues the strategy. You, however, understand the forward-looking risk. You recognize that a surprise rate cut would cause the Australian dollar to plummet, instantly wiping out months of small gains from the interest differential. So you step in. You override the system. You manually close the positions or instruct the AI to halt all new carry trades, even though its own data might suggest continuing. A week later, the Australian Central Bank announces a surprise rate cut, and the Aussie dollar drops 3% in an hour. The AI would have suffered a significant loss. But because of your contextual oversight, your capital was protected. That is the power of the human in the loop. It's the fusion of quantitative precision and qualitative wisdom. This new role also brings new psychological challenges. It takes immense discipline to not interfere with a profitable system just because you have a hunch. It's easy to start micromanaging, to second-guess the AI on every trade, which completely negates the purpose of having it in the first place. You have to learn to trust the process and the data, to let the system do what it was designed to do within the parameters you've set. Conversely, it takes equal discipline to know when to pull the plug. During a drawdown, which is a completely normal part of any trading strategy, the temptation is to let it run, hoping it will recover. The AI feels no pain during a losing streak. But you do. Your job is to objectively determine if this is just statistical noise, or if the underlying market dynamics have fundamentally changed, invalidating the AI's strategy. Making that call, stepping in to stop the bleeding, even if it means crystallizing a loss, is one of the hardest but most critical decisions a human manager has to make. So, the skill set for the modern AI-assisted trader is evolving. It's less about staring at candlestick charts for 8 hours a day, trying to spot a head and shoulders pattern. It's becoming more about being a data scientist, a risk manager, and a behavioral psychologist all rolled into one. You need to understand enough about how the AI works to interpret its outputs and diagnose its failures. You need to be a master of risk, not just on a trade-by-trade basis but on a systemic level. And you need to have the psychological fortitude to manage both your own emotions and the cold, logical output of your machine partner. The goal isn't to outsmart the AI. The goal is to enable it, to create the optimal environment for it to succeed while protecting it, and your capital, from its inherent blind spots. It's a partnership. The future of trading isn't a dystopian story of man being replaced by machine. The evidence so far suggests it's a story of augmentation, of man with machine, achieving a level of performance that neither could reach alone. The real question is no longer who is better, man or machine. The question is, what can we build together? And what does the next generation of this partnership even look like? The next generation of this partnership looks less like a trader using a tool, and more like a pilot co-piloting a futuristic starship. It's a complete redefinition of roles. The future trader isn't just an analyst or an executor anymore. They are becoming something new. An AI whisperer, a fleet commander, a digital psychologist. Their primary job is no longer to find the perfect entry point based on a candlestick pattern. Their job is to manage a team of highly intelligent, non-human agents. Imagine a trading floor, not filled with frantic shouting, but with a quiet, intense focus. A trader, let's call her Anya, isn't staring at a single price chart. She's looking at a dashboard that visualizes the mental state of a dozen different AI models. One AI, specialized in macroeconomics, is flagging a subtle shift in central bank sentiment it detected by analyzing thousands of documents in milliseconds. Another, a pattern recognition savant, has identified a fractal pattern in the euro to US dollar pair that has a historical correlation with short-term volatility. A third AI, a risk management system, is running millions of simulations per second, stress testing the entire portfolio against black swan events that haven't even been conceived of yet. Anya's job isn't to second-guess them. Her job is to orchestrate them. She's the conductor of this digital orchestra. She sees the macro AI as becoming too risk-averse based on its interpretation of political news. So she adjusts its parameters, telling it to weigh market-based data more heavily for the next few hours. She notices the pattern recognition AI is getting stuck in a feedback loop, so she takes it offline for recalibration and deploys a backup model. She is the human oversight, the source of strategic direction, the final ethical and logical checkpoint. She asks the questions the AI doesn't know to ask. Is this correlation real, or is it a statistical ghost? Is the market reacting to fundamentals, or is it being driven by a wave of irrational sentiment the AI can't comprehend? This is the skill shift, and it's monumental. For decades, the path to becoming a top trader was paved with quantitative skills, lightning-fast mental arithmetic, and an encyclopedic knowledge of market history. The AI now handles most of that, and it does it better, faster, and without emotion. The skills that are becoming exponentially more valuable are the ones that were once considered soft. Critical thinking, the ability to synthesize information from disparate fields, creativity and strategy design, and perhaps most importantly, a deep understanding of system dynamics and ethical frameworks. The new trader needs to be part data scientist, part philosopher, and part behavioral psychologist. They need to understand how these complex learning models work, not at a code level but at a conceptual and behavioral level. They need to spot biases in the AI, just as they would spot biases in a human apprentice. Was the AI trained on a dataset that overrepresents a certain market condition? Is it developing a superstitious belief, associating two unrelated events simply because they occurred in sequence during its training? These are the billion-dollar questions of the next decade. But this new human-machine symbiosis also introduces a new class of risk, one that is far more complex and insidious than anything we've faced before. We're moving from a world where humans cause market panics to a world where algorithms could do it on a scale and at a speed that is truly terrifying. We're talking about the risk of emergent behavior. Emergent behavior is what happens when individual agents, following simple rules, interact to create a complex, unpredictable collective pattern. Think of a flock of birds or a school of fish. No single bird is in charge, yet they move as one fluid entity. Now, apply that to the financial markets. We are building thousands upon thousands of sophisticated, self-learning trading AIs. Each one is designed by a different team with different goals, different risk parameters, and different data inputs. They are all released into the same digital ecosystem, the global Forex market. What happens when they all start interacting with and learning from each other? We could witness the birth of an AI-driven flash crash that makes the 2010 event look like a minor hiccup. Imagine thousands of AIs simultaneously identifying a similar sell signal, but their reaction time is measured in microseconds. They all hit the sell button at the exact same moment, creating a liquidity vacuum that cascades through the system before any human regulator can even process what's happening. The market could plummet and then rebound in the span of a single second, wiping out unprotected accounts and destabilizing the system in ways we can't yet model. The issue is that we can't fully predict their collective behavior. We can test a single AI in a sandbox environment, but we can't possibly simulate the chaotic, real-time interactions of every AI in the global market. It's a system of unprecedented complexity, a ghost in the machine that we are building but may not fully control. This leads to an even bigger challenge: the concentration of power. Developing, training, and maintaining these top-tier AI systems requires massive resources. We're talking about enormous datasets, armies of PhDs in machine learning, and access to supercomputing infrastructure that costs millions of dollars a year. Who can afford this? It's not the retail trader working from their home office. It's the giant hedge funds, the sovereign wealth funds, and the largest investment banks in the world. We are in the early stages of an AI arms race in finance. The firms with the most data and the best AI talent can build models that are fundamentally superior to what anyone else has access to. This creates a technological divide, a new form of information asymmetry. In the past, the edge was having faster access to news or a better analyst. In the future, the edge could be having an AI that is simply smarter, faster, and more predictive than your competitors. What does this mean for the concept of a fair and level playing field? If a handful of institutions possess AI that can consistently front-run the market or predict microtrends with near-perfect accuracy, it could systematically drain liquidity and profits from everyone else. The market risks becoming a game played by a few giants, with everyone else, including smaller institutional players and retail traders, relegated to picking up the scraps. This isn't just a financial risk. It's a systemic one that could erode trust in the markets themselves. And this brings us to the ultimate and most difficult question. When one of these autonomous systems makes a mistake, a catastrophic one, who is responsible? If an AI misinterprets a news release and triggers a multi-billion-dollar loss, who takes the fall? Is it the programmer who wrote the initial code? Is it the data scientist who curated the training data? Is it the trader or conductor Anya, who deployed the system and set its parameters? Or is it the company that owns the AI? Current legal and ethical frameworks are woefully unprepared for this reality. We operate on principles of human intent and accountability. But how do you assign intent to a probabilistic algorithm? How do you hold a neural network accountable? We are entering a gray zone where the lines of responsibility are blurred. A world where the most consequential decisions in the global economy are being influenced, and in some cases made by non-human intelligences that we created, but whose decision-making processes are often so complex they are effectively black boxes, even to their own creators. So as we stand on the cusp of this new era, we're faced with a profound paradox. The same technology that offers the potential for unparalleled efficiency, insight, and performance also presents us with unprecedented systemic risks and deep ethical dilemmas. We've built the most powerful financial tools in human history. Now we have to learn how to wield them. The challenge is no longer just about making the AI smarter. The challenge is about making ourselves wiser. How do we build the guardrails, the regulations, and the new set of skills needed to navigate this future safely? What does a responsible and sustainable AI-driven financial world actually look like? That vision of a responsible, AI-driven financial world isn't a distant dream we hope to stumble upon. It's a structure we have to consciously and meticulously build piece by piece. Think of it like constructing the world's most complex skyscraper. You don't just start throwing up steel beams and hope for the best. You begin with a blueprint, a foundation rooted in principles that can withstand any storm. The very first layer of that foundation is transparency. The era of the black box algorithm, where money flows in and decisions come out with no explanation, is fundamentally unsustainable. For markets to function, there must be trust. And for trust to exist, there must be understanding. This is where the push for what's called explainable AI, or XAI, becomes not just a feature but a necessity. Imagine a regulator being able to audit an AI and ask, "Why did you execute that trade at 2:37 p.m.?" And the AI providing a clear, logical breakdown of the 100 variables it considered, from microsecond news sentiment to obscure macroeconomic indicators. That's the bedrock. Without that explainability, we're just building on sand, waiting for the first wave of a crisis to wash it all away. Building on that foundation, we have the structural framework, intelligent regulation. This is one of the greatest challenges of our time. How do you regulate a technology that evolves faster than the legislative process? The old rulebooks, written for human speeds and human behaviors, are becoming obsolete. Regulators at institutions like the Commodity Futures Trading Commission are no longer just lawyers and economists. They're hiring data scientists and machine learning experts. They're trying to build their own AI systems not to trade but to supervise, to create digital watchdogs that can monitor the markets at the same lightspeed pace as the algorithms they're overseeing. Their goal isn't to stifle innovation. It's to prevent systemic risk. They're asking the tough questions. What happens if multiple competing AI systems learn the same exploit in the market and all try to execute it at the same microsecond? Could that trigger a flash crash that makes previous ones look minor? How do we ensure that AI trading systems aren't used for sophisticated market manipulation, creating phantom trends to trick other algorithms? The regulations of tomorrow will likely focus less on individual trades and more on the behavior and risk parameters of the AI systems themselves. It's a shift from policing actions to auditing intelligence. But a skyscraper isn't just a foundation and a frame. You need the skilled engineers and architects inside who know how to operate it. This brings us to the most critical component, the evolution of the human trader. The skill set that defined a successful trader for the last century is being radically rewritten. A deep gut feeling for the market, an eye for chart patterns, the ability to read the tape, these skills are not disappearing, but they are being augmented, and in some cases superseded. The trader of the near future is a different breed. They are part portfolio manager, part data scientist, and part AI psychologist. Their job isn't to manually place 5 or 10 well-researched trades a day. Their job is to manage a system that might analyze 5 or 10 million potential trades a day. Their new core skills are things like statistical analysis, understanding probability, and knowing how to design a robust backtest. They need to understand the weaknesses of machine learning to know what overfitting is, where an AI memorizes the past so perfectly it can't adapt to the future. They need to be able to spot data bias, to understand that if you train an AI only on data from a bull market, it will be completely unprepared for a downturn. The new trader doesn't ask, "What is the market going to do?" They ask, "What are the hidden assumptions in my model? What is the quality of the data I'm feeding my AI? Under what specific conditions is this system likely to fail?" They are no longer just pilots flying the plane. They are the aerospace engineers who design the plane, monitor its systems, and know exactly which lever to pull when the autopilot encounters something it has never seen before. This is a monumental shift. It means the future of trading requires a commitment to continuous lifelong learning, not just of markets, but of the technologies that are now driving them. And finally, what about the skyscraper's internal systems, the plumbing, the wiring, the safety protocols? This is the ethical development of the AI itself. The guardrails we build directly into the code. This is where the industry's best practices are being forged. For example, developers are programming algorithmic circuit breakers directly into their trading bots. If a system starts behaving erratically or exceeds a certain risk parameter, it automatically shuts down or alerts a human supervisor. It's the digital equivalent of a fire suppression system. They are also intensely focused on creating more robust models that are less susceptible to being fooled. Researchers are using what are called generative adversarial networks, or GANs, to stress test their trading AI. In this setup, one AI tries to create fake, misleading market data to trick the trading AI, while the trading AI learns to get better and better at spotting the deception. It's like a digital sparring partner, constantly preparing the AI for the chaos and misinformation of the real world. This internal technological discipline is just as important as any external regulation. It's about building machines that are designed from the ground up to be stable, predictable, and fail-safe. So, when we put it all together, the foundation of transparency, the framework of smart regulation, the expertise of the evolved human trader, and the internal safety systems of ethical technology, that is what a sustainable AI-driven financial world starts to look like. It's not a world without humans. It's a world where humans are elevated. We move from being players on the field to being the coaches and the general managers. Our role shifts from making every single tactical decision to designing the overall strategy and the systems that execute it. The AI can analyze the data, spot the correlation, and calculate the probability. But the human provides the context, the wisdom, and the ultimate oversight. The AI can tell you that a particular trading strategy has had a 90% success rate over the last 10 years. The human is the one who can ask, but are the underlying global economic conditions that made it successful for those 10 years about to fundamentally change? This symbiotic relationship is the destination. AI handles the scale and speed that is beyond human capability, while humans handle the nuance, the creativity, and the ethical judgment that is, for now, beyond the machine's reach. We are building a powerful tool, perhaps the most powerful tool in the history of finance. And like any tool, its impact, whether it builds a more efficient, stable, and accessible market, or a more volatile and dangerous one, comes down to the intention and wisdom of the people who wield it. We are standing at a remarkable crossroads. The integration of artificial intelligence into Forex and all other financial markets is not a distant, hypothetical event. It is happening right now, every single day, with every trade placed by these sophisticated systems. The learning curve is steep, and the stakes are incredibly high. The challenge ahead is not about stopping this change, but about steering it. It's about ensuring that this technological leap forwards translates into genuine progress for the global financial ecosystem. The future of trading isn't about finding the perfect algorithm that never loses. It's about the ongoing dynamic collaboration between human insight and machine intelligence. The question is no longer if AI will reinvent the world of trading. The only question left is how you will adapt, how you will learn, and what role you will choose to play as this new world takes shape. The most valuable asset in this future won't be capital or code. It will be the human mind that learns to guide it.